Picture this. Sandra, 61 years old, Phoenix, Arizona. She finds a YouTube video in 2022 about a brand new ETF. It pays every single Friday. The ticker is TGIF. And yes, that is its real name. She thinks, finally, a weekly paycheck from my investments. So she puts in $15,000. Then one morning in February 2024, she gets a letter in the mail. The fund is closing. She gets her money back, every cent, but the weekly income, gone. Today, I'm going to show you 4 weekly dividend ETFs that actually have the size, the structure, and the staying power to pay you every Friday for years to come. By the end of this video, you will know which 2 are backed by the United States government, and you will know which 2 can generate serious weekly income, along with exactly what you need to watch out for before you put in a single dollar. And the part most people completely miss? 2 of these ETFs belong in completely different types of accounts. Put them in the wrong account, and you could quietly hand the IRS thousands of dollars you never needed to. Quick note before we go further. I am not a financial advisor or a government employee. Everything in this video is for educational purposes only. For your specific situation, always work with a qualified professional. Lesson number 1. The graveyard of weekly dividends. Let's start with the warning most videos skip. Weekly and TGIF were 2 of the first ETFs ever designed to pay investors every single week. They launched with a lot of excitement. Both were built by SoFi, a well-known financial company. But by February 2024, both funds were gone. Why? They never got big enough. TGIF had around $15 million in assets. Weekly had around $11 million. In the ETF world, that is too small to be worth running. The companies closed them, liquidated the holdings, and sent investors their money back. No one lost their principal, but the income stream stopped cold. And anyone who had built their retirement plan around that weekly paycheck had to start over. This is why size matters when you are picking a weekly income ETF. A tiny fund is like a store that does not have enough customers to keep the lights on. Eventually, it closes. Every ETF I'm showing you today has either the structure of the United States government behind it, or enough investor assets to take seriously. So what actually separates the funds that survive from the ones that get quietly shut down? It comes down to one thing, and it's not the yield. It's assets under management. The bigger the fund, the more revenue it generates to cover operating costs, the more liquid it is to trade, and the more difficult it becomes for the issuer to justify closing it. I'll show you exactly what to look for, starting right now. Lesson number 2. Why weekly beats monthly, but not for the reason you think. Before I show you the 4 ETFs, I need to tell you the truth about something. You may have heard that weekly dividends compound so much faster than monthly ones that the math alone makes weekly income far superior to monthly. Here's the myth. Weekly dividends compound so much faster that they grow your wealth significantly more than monthly payers over time. Here's the truth. On $100,000 at 5%, weekly compounding gives you about $133 more than monthly compounding over 10 years. That's the price of a nice dinner. That's the entire mathematical advantage of weekly over monthly. So why does weekly income actually matter? It's not the math, it's the behavior. Think about Tom and Linda from Ohio. Tom retired at 63. He spent 38 years getting a paycheck every Friday. And when he retired, the shift to waiting for a quarterly dividend or even a monthly one felt like losing his footing. He started watching his portfolio balance obsessively. Every time the market dipped, he thought about selling. When Tom switched to weekly income ETFs, something changed. The Friday alert on his phone, even just $40 or $80, rewired his brain. He stopped watching the balance, he started watching the income. And during the market volatility of 2022, he held his positions instead of selling at the worst possible moment. That decision saved him thousands.
A financial planner once said something that stuck with me. He said, "Weekly income doesn't make you richer, but for a lot of retirees, it makes them smarter because they stop selling shares to pay for groceries." That is the real case for weekly dividend ETFs, not the math, the behavior. Now, here's where most videos stop. They just hand you a list of tickers and walk away. But before I show you the ETFs, there's a tax trap hiding inside two of them that could quietly cost you thousands if you put them in the wrong account. Smart investors need to see this before they invest a single dollar. Let's get into it. Lesson number 3, the safety floor, WEIK and MMKT. Let's start at the foundation. The first two ETFs on our list are boring. I mean that as a compliment. When you're 58, 62, or 68 years old, boring is not a problem. Boring means your principal is still there on Monday morning. ETF number 1, WEIK, Round Hill Weekly T-Bill ETF. WEIK holds U.S. Treasury bills. These are short-term loans to the United States federal government, the same government that has never missed a payment in more than 200 years. The fund buys Treasury bills with maturities between 0 and 3 months. Each week, it collects the interest the government pays and sends it directly to you every single Friday. Current yield, approximately 3.5% annually. Expense ratio, 0.19%. That's $1.90 per year on every $1,000 you invest. Assets under management, $144 million. This is not a tiny, fragile fund. On a $50,000 investment, you'd collect roughly $30 to $35 every week. That's not a fortune, but it covers a utility bill, and you know with near certainty it will be there next Friday. ETF number 2, MMKT, Texas Capital Government Money Market ETF. MMKT is WEIK's close cousin. It holds government money market instruments, things like Treasury bills and repurchase agreements backed by U.S. government securities. It's also the first ETF designed to follow the strict rules that govern traditional bank money market funds. Current yield, approximately 3.5 to 3.6%. Expense ratio, 0.20%, almost identical to WEIK. Assets under management, approximately $65 to $78 million. Both funds pay every single Friday. Both are designed to preserve your principal. Now, here's the tax advantage that almost nobody talks about, and this one is worth real money. Because WEIK and MMKT hold United States government obligations, the income they generate is exempt from state and local income taxes in every state in the country. If you live in California, state income tax can be as high as 13%. In New York, nearly 11%. Even at 5%, the state tax exemption adds meaningfully to your real after-tax income.
Now, and this is the critical tax rule, hold WEIK and MMKT in a taxable brokerage account, not an IRA. Inside an IRA, all withdrawals are taxed as ordinary income regardless of source. You lose the state tax exemption entirely. The only way to capture it is to hold these in a taxable account. That is the smart move. Before I walk you through the income engine, drop a comment right now. Are you already in any weekly or monthly income ETFs, or are you just starting to explore this strategy for the first time? I read every single comment, and your answers shape every future video I make. Lesson number 4, the income engine, QDTE and XDTE. The safety floor gives you steady, reliable income, but you came here for the income engine. Let's talk about these two funds honestly, because the numbers look almost too good to be true, and in some ways they are, and in some ways they are not. You deserve the full story. ETF number 3, QDTE, Round Hill NASDAQ 100 0DTE Covered Call ETF. QDTE holds the NASDAQ 100. You know this index. Apple, Microsoft, Nvidia, Amazon, the top 100 non-financial companies in the world. But QDTE does not just hold those stocks and wait for dividends. Every single morning, the fund sells options on the NASDAQ 100 that expire the same day. These are called 0 days to expiration options, or 0DTE for short. Here's how it works in plain English. Imagine you own a house worth $100.
Every morning, someone offers you $2 to let them buy your house at $102, but only if the price actually reaches that level by 4 o'clock. If the price stays below that, they walk away. You keep the $2. QDTE does this with the NASDAQ 100, every morning, every trading day. The premium it collects, that $2, becomes the weekly distribution paid to your account every Friday. The result, QDTE currently generates a distribution yield of approximately 35 to 48% on an annualized basis. ETF number 4, XDTE, Round Hill S&P 500 Zero DTE Covered Call ETF. XDTE does the exact same strategy, but on the S&P 500 instead of the NASDAQ 100. Distribution yield, approximately 20 to 36% annualized. Expense ratio, 0.95%. Assets under management, approximately $355 million. QDTE has gathered $860 million in its first year. That's a serious fund. The NAV truth. Now, I need to show you something that most YouTube videos on these funds simply do not show you. QDTE launched in early 2024 at $50 per share. Today, it trades at around $29 to $30. That's a 40% decline in share price. XDTE launched at $50. It now trades at around $38 to $39, a 22% decline. Does this mean these funds are failing? Not automatically. Let me show you why. The distributions from QDTE are classified as return of capital, ROC for short. That means the fund is essentially returning a portion of your own investment to you each week, rather than paying you pure income. The IRS does not tax return of capital immediately, but it does reduce your cost basis over time. What matters for the full picture is total return, income plus or minus price change. QDTE's total return with distributions reinvested over its first year was approximately 22%. That's positive. That's competitive with the NASDAQ 100 itself. But let me show you what happened to Tom. Tom is in Arizona. He puts $50,000 into QDTE in early 2024. Every week, income hits his account. After 1 year, he's received approximately $18,000 in distributions. It feels great. Then he checks his account balance. His $50,000 position is now worth about $29,000. He's down $21,000 on paper. Here's the complete picture. $18,000 received minus $21,000 in price decline. On the surface, that looks like a net loss of $3,000.
But here is the difference. If Tom had reinvested every single weekly distribution back into the fund, buying more shares at lower prices, his total return turns positive. He accumulated more shares at a discount, and his total position recovered. This is the critical insight. QDTE and XDTE are not standalone retirement income tools. They are one powerful engine, best used inside a Roth IRA, where the return of capital complexity disappears, and where every dollar of income and growth is completely tax-free. Put them in a taxable account, and you create an accounting headache that compounds for years. Put them in a Roth IRA, and the strategy becomes clean, powerful, and simple. Lesson number 5, the 2-tier weekly income plan. Let me show you what a complete 2-tier weekly income portfolio actually looks like. This is for educational illustration only, not a recommendation for your specific situation. Imagine you have $200,000 to put to work. You put $100,000 into WEIK and MMKT, split evenly inside your taxable brokerage account. At roughly 3.5%, that generates approximately $3,500 per year, about $67 per week, state tax exempt, principal as safe as United States government debt. You put the other $100,000 into QDTE or XDTE, or a blend of both, inside your Roth IRA. At current distribution rates, this tier generates variable weekly income paid every Friday, completely tax-free. Here is the most important part. When the stock market drops, and it will drop, you stop drawing from the Roth IRA. You live on the safety floor income. Your QDTE and XDTE positions sit, accumulate distributions, and wait. When the market recovers, the income engine starts running again. This is the exact mechanism that protects you from sequence of return risk, the danger of being forced to sell your investments when they are down. One more thing to plan for. As the Federal Reserve continues to cut interest rates, which many economists expect through 2026, the yield on WEIK and MMKT will drift lower. On a $100,000 position, each quarter-point rate cut reduces your annual income by approximately $250. That is not catastrophic, but it is real. Build your plan knowing the floor income will move with rates. Let me leave you with one line to take away from this video. Weekly income doesn't make you richer, but for a lot of retirees, it makes them smarter because they stop selling shares to pay for groceries. That is the real case for weekly dividend ETFs, not the math, the behavior. If someone in your life is building retirement income right now, a spouse, sibling, a friend at work, share this video with them today. Understanding the two-tier strategy could genuinely save them a serious amount of money. Drop a comment below right now. Are you leaning toward the safety floor, the income engine, or the full two-tier plan? I want to know. I read every single comment. If you want to stay ahead of new ETFs, new tax rules, and new income strategies in 2026, subscribe to Dividend Hustle. I cover everything that protects your retirement income. And in the next video, I'm going to show you a hidden tax trap that quietly raises Medicare premiums for retirees who collect too much dividend income. It's called IRMA, and most people don't even know it's coming until the bill arrives. You won't want to miss that one.